Good morning and happy Monday. Julian Williams here. Welcome back. I get the pleasure of hosting Global Traders expert Boris and Kathy. How are we doing this morning, guys?
We're doing great.
Great. Lots of activity in the markets.
Yes.
These are the days we live for, right?
That's it. So let's go ahead and dive into it.
Yeah. So, Kay, you want to start? Do you want to give the macro lowdown as to what's going on?
I mean, look how things change in just a couple of days or over the weekend. Boris and I were talking about last week how the market was kind of divided on 50 versus 25. Boris was pounding the table on 25 basis point hike from the Fed. And this banking crisis happened. And guess what? Now the market says zero chance of a half point hike. And now, the odds are flipping between no hike and 25. There's, at some point, the market's looking at a greater chance of no hike than 25 basis points. So a lot has changed as a result of the banking sector, meltdown. And even though the Fed came out, late Sunday with all of these initiatives to try to support SVB and Signature Bank depositors, we all know that there's just never, one cockroach in the cracks. There's more to follow. There could be, there could be water bugs. There could be, lots of different types of insects that come out. And I think, that's really what the market's worried about. You can see, equities are melting down. They're worried about the slippery slope that follows.
If I can just jump in here, I think that's really an important point. Everybody expected Silicon Valley Bank. And, if that was the only problem, I think the market would have been a lot calmer. But I think what surprised the market was the Signature Bank in New York. And then today, First Republic, which is a big bank in New York. This is not a small bank. There's a lot of branches in New York City on it. The stock is down 77% in 5 days. It's clearly a, investor concern on it and some kind of bank run. The point being is, if it's one bank, it's completely manageable problem. If it becomes 100 banks, it's a huge problem because you're just, it's like playing whack-a-mole with depositors. And I think that's the inherent risk here. Whether that happens or not, we'll have to see. But just the investor panic is really what you're seeing ripple through the markets as we start the day.
But I have to say, and Boris, you can, add your insight. The problems that SVB had are problems that probably a lot of banks face because they plowed their money into treasuries, which they thought was safe, and what everyone tells us is the safest assets. Fed started to raise interest rates. Those value of the treasury holdings started to plummet. I think many banks are kind of in that same boat. And that's why investors are so worried, particularly the regional banks that have less stringent capital requirements than the JP Morgan, Citibank, the behemoths of the world. So I think, this fear of contagion is legitimate.
Yeah, I would say that the big problem here is a matter of sophistication. All the top four banks, Morgan, Wells Fargo, Citi, B of A, not only hedge, but are almost required to hedge by the regulators. So all of them had interest rate swap hedges on, meaning that it's essentially kind of like, I think of it like an options market that basically buys insurance on the fact that treasury bills and bonds are going to go down in value. And so whatever losses they have on the books in terms of, the bonds that they're holding, they have gains off their option positions, their hedge, their swap options on the positions. The lower tier banks, first of all, don't have nearly as sophisticated risk control measures, but more importantly, kind of like, I don't want to pay money for insurance. It's expensive. That's what Silicon Valley Bank, literally a $250 billion asset bank, $250 billion bank, did not have any hedges on. So the problem isn't necessarily that treasury bills go up or down. They're going to go up or down with Fed policy. They just had absolutely no risk control. It's a good lesson for all of us traders. They had no risk control on the books whatsoever. They were basically winging it, hoping. They were basically hoping for not a margin call. And of course, when you hope for a non-margin call, you're always going to get a margin call. And that's literally what happened to them, and what may be happening to some of the other banks where there isn't a stringent enough risk control layer in place that's hedging away all of this interest rate volatility, which was a given. You're going to have interest rate volatility. The big banks have hedged it away. The small banks have not. If that's really true, it's a bigger problem than just this one story.
Now, Boris, how do you kind of, what do traders do? How do they take advantage of this kind of, this news? In
You
light
know,
of
for us, I mean, trading is all about movement. It doesn't matter whether the movement is up or down. It's the amplitude of the movement that, what we hate the most is when the Dow does a 25 basis point day where, it's a 50 point in the US 30 and you're watching paint dry and you're ready to just put your head through the wall, right? You and I both hate that. When we have 5, 6, 8, 900 point swings from high to lows, and not just one, but maybe 2 or 3 during the day. I mean, those are excellent opportunities for both scalping or swing trading because that's where you have the potential for profit. It's a matter of just simply isolating and identifying the direction. But if you can hop on that move, that's where all the profit is made. So today is a great day. I wrote today, actually, I tweeted out. I said today is a great day for trading. It's not a great day for investing. It's not a great day if you're a banker. But it's a great day for volatility, which is what we love to do.
I also have to add, one of the most important things for traders is that on days like this, you have to either get in and out quickly or you have to widen your stops because there's going to be so much intraday volatility and there's so much, pip by pip volatility that, if your stops are too tight or you're not, getting chucked up out, in and out quickly, you are definitely going to get hosed. And that's really, what we did last night. I mean, last night, right at the Asia Open, I mean, Julian, I love to trade the Asia Open and the New York Open. Right at the Asia Open, we're still in the midst of the concern. The Fed hadn't made the announcement yet. So we jumped in to those short yen trades, short dollar yen, short euro yen, short Kiwi yen, on the assumption that, Asian investors are going to wake up. They're going to want to press the sell button. That happened. Our targets were hit quickly. But, I squared up everything overnight right after the announcement, even though I believed that the Fed, that this wasn't enough for the Fed and that, the investors would turn their eyes onto the regional banks. It was important to be out. And so, when I woke up in the morning, even though, all the yen crosses were trading lower, I looked closer at the charts. I would have been stopped out because of the intraday volatility if I held on to those positions, because it spiked overnight after those announcements into Europe and then went down again. So that's why it's really important to be conservative. We went back into those short yen trades this morning, but that's the key to managing your positions in this environment, which is that, when we've got a banking crisis, you're going to be sitting at your desk watching those charts. It is not the time to be holding these positions for a while, because even last night, I would have been, if I didn't close my positions before I went to bed, I would have been stopped on the spike, even though it was 100 pips lower when I woke up and looked at my charts. So that's why, this is the environment for traders, as Boris said, not for investors. And it's good for us because, we're traders. We like to be in and out of the markets.
Exactly. Yeah. I went ahead and just, steered clear of it. I actually just, completely avoided the US 30 move this morning. I got in a little bit of gold, took that thing up. Obviously, as you know, that's a nice hedge historically. So I went ahead and took some buys and, got in, got out, like you said.
That's good, and that's a smart way of doing it. Sometimes what you want to choose is a lower volatility side asset, sort of adjacent asset that can let you trade. The other thing that you want to use, a really good rule of thumb is whatever your normal trade position is in terms of size and stops. What you want to do on high volatility days is half the position at twice the stop. Just for argument's sake, I don't know, your one lot in US 30, your stop is your normal stop is 50 points, right? So that your high volatility position should be half a lot at 100 points. In order to give yourself both. That way, you're risking the same amount of money, but you've widened your area of control. It's just a rule of thumb, but it's a good one I use all the time.
So, I think, what everyone's wondering right now is, what now going forward? First of all, stocks have completely reversed their earlier losses and the Dow is up, almost 200 points right now. So, the market is still trying to, is playing the guessing game and trying to figure out what all of this means. And I think, there are two main takeaways. Number one, which we talked about already, that this is not the end of the bad news announcements from the banking sector. Number two, and probably in my opinion, the most important, is what this means for the Federal Reserve. And one of the reasons why the stock market completely reversed itself and is now positive is because the market's thinking, this is going to stop not just the Fed's tightening cycle, but possibly a tightening cycle of a lot of central banks. The RBA was in a pause, the Canadians were in a pause, but now, they could end up just shutting the door. And even, the European Central Bank, who's got a meeting this week, and we can talk about that later, they could start to slow down, even though, they had last week been very crystal clear, saying the pound the table, we're hitting the accelerator button. So, stocks are rallying because they think this could finally mean the end of rate hikes. And this week, even before this whole banking debacle, last Friday, we talked about how it's going to be a big week because we have inflation and spending data. But, what is now, we're in a different position. Everyone's going to look at, how bad the number is and look at it from a negative light. Meaning that, previously, if inflation was lower, they'd be like, but the year-over-year rate is still high. It's well above 2%. Fed's still going forward. Now they're going to think inflation is easing. There's no way they're going to do 25 basis points at the next meeting. This is the end of tightening. So everything will now be looked at from a negative light. And that is a very important mindset to shift.
It's really interesting how the narrative changes. I remember we talked about the fact that it's a kind of a bipolar market, that it just sort of, or schizophrenic market, that it just sort of narrative changes every 2 weeks. So we went from like, oh, we're close to terminal rate, we're sort of in a sweet spot, we're in a perfect soft landing conditions, economy is strong, but the Fed is going to pretty much stop at 4.5, 4.75, 5%, right? Then we went to, oh no, inflation is really hot. Terminal rate could be as high as 6%, maybe even 7%. Like, everybody started thinking that, right? Then we went to, oh my God, we're in a banking crisis. The Fed is not going to raise any rates. As a matter of fact, they may even lower rates. And we could go into a recession because all credit is collapsing. So, I think the truth is always somewhere, probably somewhere in the middle. I think what's very likely is the Fed is definitely going to go 25 basis points because they're going to try to maintain, some kind of discipline. But they will certainly say they're keeping an eye on, the banking conditions. What will be very bad for stocks, for the economy, and for policymakers is if tomorrow's CPI comes in considerably hotter than we expect. Because what happens is when the data, forces the policymakers' hands into a completely opposite direction they want to go to, they're kind of trapped. Everybody knows the Fed has to really take their foot off the gas right now if they don't want to hurt the banking system. But at the same time, if you see large, increases in prices, that's going to be very hard for them to justify. I'm gonna reserve judgment until tomorrow. This is what trading is all about. Not about, figuring out what you think is going to happen, but what you think you should happen, but what is actually happening. So I'm going to reserve my judgment as to how we trade until I see the data tomorrow. If we sort of in line, or even just marginally hotter, I think it's okay. If we're quite hotter, if we're like 20 basis points hotter, that's going to be a big problem for everybody. It's gonna I think whatever. If we have a rally into the close today, it's going to be a collapse tomorrow. If, however, it's actually cooler, that should be quite positive for equities. We could have a big rally tomorrow in equities, because what that means is that the Fed is under no control or under no pressure to have to hike rates further, and therefore that could create a much more gentle environment for monetary conditions in the stocks in general.
Now, here's what's interesting, Boris. I'm looking at Bitcoin here, and I'm seeing it's trying to make a rally. You think it's just kind of an overreaction of what's happening with
Bitcoin is I'll be the first one to say I have a very, very biased view of Bitcoin, so it's really hard for me to kind of objectively judge it. Bitcoin is clearly acting as a risk asset, right? And I think in many ways, Bitcoin acts with the expansion of the balance sheet of the central banks. Like, the more money they print, the easier it is then to put that money into a non-asset like Bitcoin. The hardcore Bitcoin fundamentalists will tell you, oh, this is why you want to own Bitcoin, because it's hard money. It's it's going to be an asset. Let me tell you, I mean, I am maybe I'll be proven wrong, but I really doubt that if we go into some kind of a global recession and there's some kind of a banking run and we have all sorts of currency issues, that people are going to say, oh, let me trade my Bitcoin across state lines as a store of value. I think that's going to be a much at that point it's going to be people are going to be liquidating everything. Bitcoin is the ultimate speculative asset, so it's responding, and it was racing. I mean, the trade for those people who actually trade on the weekends was that you could have bought Bitcoin earlier before you knew the SVB news was going to be positive. You could have bought that because it rallied in front of it, like it rallied 6 or 7% in front of it. But long term, I'm still incredibly dubious as to whether this has any kind of legs as an asset. I still think it's it's more of an amusement.
I want to show you a chart. Here, let me try to share my screen. Give me a second. So this is no surprise. This is just basically highlighting what Boris said. The orange line is the US 30. The candlestick is Bitcoin. Bitcoin basically takes its cue from stocks. So if you're saying that Bitcoin is soaring right now as a result of the turn in positive sentiment, you can see that in stocks. And this is an hourly chart. If we went back even further, you can see these are near mirror images of each other. So whatever view you have on the equity market is going to be the same view that you have in Bitcoin. It's just magnified with Bitcoin because obviously the vol is a lot higher. So the question going forward about whether or not Bitcoin is cheap at these levels is whether or not you think the central bank is done, right? Because as Boris said, we talked about how I said everything's going to be looked at negative light because for me, when we have softer inflation, that's negative dollars. But Boris is saying, it's going to be positive. It's a positive development because it is. It's positive for stocks. They can move in opposite directions, in this type of environment. So if we do get that weaker inflation data, then, the stocks are going to rally and it's going to be positive. You find Bitcoin, trading, much higher than where it is right now. But if the markets turn nervous again, then the equities go from plus 240 in the Dow to minus 500. There's going to be no buyers of Bitcoin because something else is happening that the investors are worried about.
Right.
I'm going to change this to the regular price scale so everyone can see that. But correlations are extraordinarily important in the markets. I watch correlations all the time. And one of the most important correlations that I like to watch is, for those of you that like to trade dollar yen or the US dollar, let's get rid of the US 30. But you can see here on the 1 hour chart that the orange line, US 30 and dollar yen also have a very, very tight correlation. But, there's nothing more important to the direction of the dollar than bond yields. And let me just kind of put this on the other scale. And make sure they're all on regular. You can see mirror images of each other. So trading currencies oftentimes is just about following where yields are. So when yields, you see 10-year yield down 5%, don't be looking to buy dollars. You only want to be selling dollars. And once you learn these correlations, like Bitcoin stocks, yields, dollar, they don't change. You just kind of have them on your radar, and you learn to look at the markets from different perspectives to make sure you're aligning yourself in the right direction.
When you're looking at the market, Kathy, and Boris, you can chime in on this as well too. What kind of, especially for the viewers here, indicators, things like that you guys are looking at. That way they're kind of getting an idea of where the general consensus is going. Whether it be market structure, EMAs, MAs. What are you guys like looking at when you're peeking at the markets?
Well, when I start my day, I always look at, how equities are trading. I look at like we just mentioned, how the bond markets are trading. That's very, very important to me because equity determines risk appetite. Bonds determine, kind of the direction and the bias of the dollar, and stocks do that as well. And then we all have our own indicators. Like I love Zip. I traded dollar yen last night. This is when we went short. We also went short euro yen off of this Zip sell signal. I don't know. Is my chart updating?
We don't see anything updating right now.
Let me just refresh it. Let's see. I use Zip. Zip is my baby. It's my indicator. We had a short sell. We're below the indicator line throughout the Asia session. This morning we had a short Zip sell signal. I don't think you see my charts right now, but I always look at my Zip charts, and then I love moving averages and whether or not we're buying into resistance or selling to support, or we have the clearance. But this kind of was one of the main reasons why I jumped into the euro yen trade this morning. I posted on Twitter, my handles in my name. And I posted on Twitter before it actually moved, and we could have easily caught a 60 pip move on my trade call over Twitter because we caught this zip sell signal. But that combined with the bigger fundamental story, the stocks, the bonds, and moving averages is what drives my trades.
Okay. Boris, how about you?
I keep it much more simple. As a matter of fact, we can talk about what drove my trades because we did this on Friday, so I think it's a good time to kind of review. So let me see if I can present. Share screen. Okay, share screen. Which screen do I want to share? I want to share this one. I think it's the US 30. This one, yeah. Share. Okay, are you guys? Yeah, are you seeing? Let me see. Yeah, there we go. So you see my screen. You can see that I have a huge monitor, so it's completely elongated. So what I remember, I'm a huge believer in highs and lows of the day, the week, the month. This is something that I learned from market wizard Linda Raschke, but also I learned from in the olden days when Kay and I used to sit, next to each other on the desk at FXCM. The dealing room at FXCM, like they would only have one thing on their whiteboard, which was the day's high, the week's high, the month high on every currency pair, and the dealers kept an eye on that. And that really left an impression on me because it basically showed that there's only one thing that matters. It's the price of the instrument and how it is relative to, the extremes. So if you guys remember on Friday, Julian, remember that, we had this conversation. I'm just going to go back to Friday. I'm going to go into replay mode just for 1 second. Let me just go back to Friday. Okay. So I think we were talking. This was at 11 o'clock in the morning, right? I think this was that. And let me just go. We're talking actually about the S&P. So let me let me drag this back a little bit. I'm going to go into replay mode just to show you. I want to have to do this manually because otherwise it's going to be too annoying. But if you guys remember, so I remember this conversation. I remember that we annotated the chart, and you were like, and Kay was like,
use your highlighter.
Highlighter, right? So it was around 11 o'clock in the afternoon. So this is 11 o'clock, right? And I was saying, okay, we're looking at days highs, days lows, and I think we can actually go into if I go into replay mode here. Let me see if I can do this. Okay. So this is essentially emulating what's happening on Friday, right? So this is my bounce indicator showing you highs and lows, right? So you and I are talking, and I was like, oh, look, it looks like it might go to session highs. But here's what I said to you. I said, remember that 38 level? Let me go to my highlighter. Let me just redo this. So we go highlighter. I said, pay attention to this because if we break the lows, it is not a time to buy. It is going to be a waterfall. I remember we talked about that. So look what happened in the price action. After you and I had a conversation, I said, watch the lows, because that means, we had positive news. And if the price action is negative against positive news, boom. Look at this. That was over here. This is the waterfall. So it was 84. Now it's 65. And I think it just kept on going. And it just kept on going.
What time was that, Boris?
Oh, yeah.
So when did that happen? So that happened. So we talked at 11. You can see it on the bottom. We talked about this at 11. At around 12 o'clock, 12:30, it started to break the lows, and then it just collapsed, right? It just collapsed, and it went 40 points. So here's what happened actually. But this is why this is such a good strategy. What happened actually was we had positive non-farm payroll news, which was initially positive for the market, but then everybody started worrying about Silicon Valley Bank, and that trumped all the positive news, which is why this is why it's such a good setup. If news is positive but price action is negative, usually something much more important and much less obvious is happening in the markets that you may not know about or you may not have thought about, but somebody who's a lot bigger and smarter has already thought about it. And it's really pays attention. Put your ear to the ground. When that happens, you go with the flow because that's, the big boys know what they're doing. Had you taken that trade, it was good for 100 points in the S&P. I mean, it was good for about probably like 500 points in the Dow, in the US 30. And it's a classic setup. Hopefully some of you guys did it on Friday. But if you didn't, just remember it for the future. if you're breaking the lows against positive news, you want to go with that break because something else is happening that is far, far more important than whatever is the news that was driving it an hour ago.
Right.
Yeah.
Well, I mean, to your point there, Boris, I think we've all been on that side where, we think we're, trading here as an institutional, bank or whatever, and try to jump in there early and get burnt on it. So like you said, just let it find its legs. That's kind of my idea between US 30 today. I said, well, let me go ahead and wait till about, 10:30, 11 till it really starts to find its, and, lo and behold, we're starting to get some bouncing, some
right.
higher highs today.
Correct. And what's happening now? Look what's happening now. We are starting to see we're above the midpoint. This is the low point. This is the midpoint. This is the balance of power, the equilibrium. This is the high of the day. We just broke the equilibrium to the upside. I think we probably rally a little bit here. This is the S&P actually. I'm just looking at the S&P. So the S&P is kind of leading us the way to the upside. I wish I was trading the S&P today instead of the Dow. It's a really good trade. But yeah, I mean that's what's happening. And it's actually, by the way, this brings another good point. Is I know Kathy does this all the time. If you're trading one particular instrument, it's good to look at the adjacent instruments. Like, if Kathy's probably trading the yen, she's trading yen or trading yen crosses, she's going to look at a couple of yen crosses to see if whatever she's thinking is permeating its way across the full market rather than just, one instrument. Or maybe there's some kind of an interesting, lead insight into one of the pairs that could be leading the rest of the market. So it's always worthwhile to look at the adjacent instruments, even if you're trading one particular instrument that you're focusing on.
Yeah, that's really true. Like I'm watching Euro Yen right now, and when you trade Euro Yen, you have to watch Dollar Yen and Euro Dollar because you need to understand what's driving the move. And it's 100% Dollar Yen and not Euro because Euro's rallying, and so you have to watch both of the instruments carefully. And sometimes one is leading the other, and you have to have a view on one of the pairs. Now Boris touched on one. With Boris's strategy, and even with what I do. When we look at, how stocks are moving, how bonds are moving, the whole purpose of all of that is to recognize what the market is, not to guess how the market's feeling, but to recognize what the market is doing already and how it's feeling, and then getting into the trade.
I got the logo. Assess, don't guess.
The slogan.
Good one.
I got the slogan. That is to assess rather than guess. Yes.
And that's what we do. I mean, there is obviously some type of assumption that that things will get worse before it gets better, or we think CPI is going to be one way or the other. But at the end of the day, we let the price tell us and the price confirm our view, because you can have a very long-term view that inflation is slowing, but that may not matter today or this week. And so you need to recognize and respect the price action, which is what we incorporate to every one of our trades.
Okay, great. Now, guys, let me ask you this, kind of playing a little bit of devil's advocate. If the Fed tightens, does it cause irreparable damage? What does it mean for the outlook?
Oh, yeah. I think it causes really bad damage.
Yeah.
Yeah. I mean, what do you mean by Fed tightening? If the Fed does 50?
Exactly.
Suicide move. Suicide move.
All right.
They're not going to do it. I mean, if they do,
they know that.
Yeah. I mean, the only way I could see it, if let's. I don't want to because I don't want to speak.
Powell basically would put on the chopping block. I think you're going to see members of Congress, everyone screaming and yelling at him.
So core tomorrow, everybody's looking for core at 5.5, right? 5.6 was last month.
Right.
If core comes in 6.2. Yeah, then he's got a gun to his head. It's just it's a terrible choice. But core coming in at 6.2, is there any chance you think that would? I mean, we're seeing declines in everything, not increases in everything, right? 6.2 is just a massive thing, and it's got to be. And if it comes in, it's got to be some weird, funky thing like owner's equivalent rent is adjusted incorrectly or something like that. I mean, generally. Price levels have been steady. Gasoline is like under $3 in Jersey. I mean, I know it's not that way by you guys, but in places where I travel, it's really gotten much more. palatable. I don't know what are eggs. Somebody was busting
Yeah,
chops,
I
my
was.
chops, with the price of eggs because I had no idea. But eggs, they're definitely flatlined. I mean, nobody's paying like ridiculously huge numbers anymore.
right.
And I think so. I can't imagine headline being that much harder. But you never know. That's what makes markets. Whatever you think is not necessarily what's going to happen. So
I think the greater chance is, and the bigger question is 0 or 25.
Okay.
Because, like Boris said, none of the data, U.S. retail sales or inflation, based on everything we talked about on Friday, and even looking at the gas prices and looking at the concerns that retailers have, they're not going to confirm the need for a bigger move. And with all of this happening, he's gonna have his head chopped off if he does 50. So
Right.
is it 20, 25, or is it 0? And the market wants 0. And if he wants to kind of stabilize, sentiment, he should do 0. But, inflation, like Boris said, is still above 5%. And, this may be his last chance to squeeze in another 25.
Right.
by the way, in case anybody is wondering who's watching us, so this is an LG monitor. It's a single monitor that is actually 2 monitors wide. So it's 1440 on one on top of the other into one single monitor. That's why it looks so huge
Elongated, right?
And it elongated on the screens. But it's awesome, and I have like two of them running off my laptop. So if you because what it allows you to do is you can have like lots of charts on here. It basically creates 4 spaces for you instead of 2 spaces.
But then why don't you just use the tile mode in TradingView? Because then you can have 4 charts in the same chart.
You could use the tall mode, but then this is wide and tall. It's just cool.
You just want to have the fanciest gadget.
I bought it because it's cool. All right, that's all it is. That's the real reason I bought it. I like it.
It is cool.
So I have 2 of them, and I just just in case you guys are interested. Anyways, so that's basically how things are sort of shaping up as we're going forward into the week. We'll see. We'll see where things go. For now, it definitely does look like the worst is behind us for the day. But again, as I said, if we start breaking the lows who knows? Something may come out in the afternoon. Some other big bank, First Third, which is a big bank in, or what's the big bank in Florida where you guys are? It's PNC, right? Whoever knows. There's just a lot of these banks. I don't think, frankly, that their books are bad. I think they're, banking regulation and also banking underwriting has been very, very good. But you never know how much interest rate risk there is on the books that's unhedged. And that's really what Kathy was talking about. So we never know. It's always, from our past experience, she's right. It's never just one, it's never one person doing the bad thing. It's always like almost everybody getting caught. So we have to be very, very careful. For now, the bid is into the close, meaning that, the market seems to want to rally. And it'll be interesting to see if we can take out the highs. If we can take out the highs by 2:00 in the afternoon, it's very likely we're gonna finish strong. But we're gonna be watching this very carefully. But this is a really good, and by the way, everybody who's watching us, this is the reason why it's so great that you guys have, that you have Surge, because as part of your Surge addition, you get access to our indicators. And you can get zip, you can get bounce from me anytime you come join us and be able to instantaneously see where the highs, the lows, the midpoints are, all of that pre-configured for you. Just gives you a much, much sharper view of the market without you having to do any work. And same thing with Kathy. You can see, how the momentum goes on her zip conditions. You don't even have to necessarily trade any of these instruments. You can just simply put these indicators on those instruments just to give you a sense of where the market is at.
Yeah, it flows, absolutely.
Yeah.
But I do think we all have to be careful because this is very reminiscent of 2008, where we had a bunch of rate hikes, especially with the ECB coming right before or right around the Bear Stearns debacle. And so, it's the environment is very much the same. And if you remember what happened after that is that a few months later, the ECB and everyone else had to go into rate cut mode. So the market is pricing in our interest rate cut for the Fed beginning in, as early as September of this year. But they're definitely looking for one by the end of the year, with 5 more over next year. So the curve has shifted significantly. And, even this morning, I tweeted about how, in the beginning of the day, the market was only pricing in, a 30% chance of no hike. and now it's gone up to 50. So things are changing pretty much minute by minute, and it could still change. And that those changes will definitely affect the price action in US 30, the price action in currencies. And it goes back to what we talked about in the very beginning. Smaller positions, wider stops, banking crises don't come often. Be careful, be nimble, be fast with your profits.
Right.
And by the way, it's always a banking crisis, isn't it? I mean, like if you think about it, what really destroys the stock markets? It's always a banking crisis, whether it be LTCM. It's always somebody borrowing too much money without hedging their risk, blowing it up, and then everybody else has to scramble because if we don't scramble, everybody else goes down with it. That's just kind of like it's always the same story. Just the players change, but the story is
exactly. So then,
Right.
So Thursday, obviously, we've got the jobless claims, and and building permits. Any comments on those? What do we think it's going to come in at?
So ironically enough, by the way, if rates kind of moderate, right, and we see, my chair suddenly went down on me. If rates moderate, right, we have to gonna watch the mortgage rates. Mortgage rates went to 7. That was just, you might as well just choked off the whole housing market. They started to come in. I think the housing market has an intrinsic bit in it. There's just not enough housing in America. We're not building enough housing. There's a huge amount. Now lots of family formations. People, millennials are getting older. So there is this, I think, underlying bit. It's just a matter of making it. It's utterly unaffordable now. So if interest rates come in, that actually is super great for the economy because housing is such a big part of the U.S. economy. The thing that the Fed has done that was very, very dangerous and toxic was that it destroyed the most kind of important part of the U.S. economy, which is housing. Which is sort of has a lot of employment, a lot of investment, and it's a lot of demand. At this point.
Yeah, my brother's looking for a new home, and he went to open house this weekend, and the spring market's just starting. There was 100 people online waiting to get into this house. And it wasn't even a very spectacular house. It was just that this lack of inventory, as Boris said. And people are just itching to buy whatever they can see, even if it's fixer-upper that needs a lot of work.
Yeah.
No doubt. Like I said, good for those who are looking to sell, but bad for those who are trying to get into it.
It's just not as bad as investors have feared.
Right.
Exactly. So ironically enough, this kind of a pause in interest rates and a fall in bond yields should actually be, could building permits and everything else could rebound, and that could be good into the summertime because what you don't want into the summer. The worst case scenario. We can sort of flow chart this. Worst case scenario: inflation super strong. Fed has no choice but go 50. Destroys the housing market. We're basically in like the really horrible recession, like 2008 recession. Everything collapses. A best case scenario is the banking is contained. We have a couple more weeks of worry, but everybody kind of muddles on through. Rates at this point stay low, and more importantly, inflation stays muted, so the Fed doesn't have to sit there and constantly berate everybody about inflation. By the way, my last thing about inflation is, I think the world of 2% is long gone. The Fed and everybody else has pretty much knows it. They just don't want to admit it. Nobody thinks inflation is going to be 2% for the next 2 or 3 years. It'll be 3%, but 3% is completely manageable, completely doable. Again, the problem with inflation isn't that it's a sort of a level of increase. It's the jump in the level of increase that completely destabilizes people. Once people are used to that, okay, everything is going to be 3%, my wage is going to be 3%, my inflation is going to be 3%, you're not really losing that much purchasing power, you're okay. But it's just the fact that, my wages are up 2%, but everything else is up 20%. That's the worst. That's, those are the elements that the Fed tries to fight. So if we can mute all of that, we can muddle on through. But we'll have to, again, as Kathy and I say, we're just going to look at the data. We don't know. We'll just have to take our cues from what the numbers come out this week.
Exactly. Like you said, people don't like change too much. They don't want it to happen too drastically.
Yeah. Kate, do you want to talk a little bit about ECB? Because that's going to be a separate story. Might have some interesting flows in FX.
Yeah, we touched on the ECB. We talked about how they've been crystal clear in how they want 50 basis points. But the market's wondering, whether or not all of this uncertainty is going to shift them 25-50. Now, ECB is traditionally one of the most stubborn central banks I know. And when they say and they put their minds to doing something and saying something, they don't care what else is going on. And so, while the environment has changed a lot over the weekend, I think there's been so much consensus within the central bank, is so much fear of inflation, because unlike the Fed, which is a balance of unemployment and inflation, the ECB, the true mandate is just inflation. And so they, I think, are going to plow forward the 50. Now, the question is what comes next? This ECB meeting, they're going to release their economic projections, as well as, the ECB president's going to speak. She's going to provide her guidance. That's really what is going to be important. We're going to be live trading it. And with the central bank meetings, especially ECB, FOMC, it's a two-pronged event. You got the first, the rate decision. And this month, we talked on Friday how it's daylight savings, and we're in that 1 month period where the ECB rate decision comes out at 9:15 instead of 8:15 New York time. So it's coming at 9:15. That's going to be the rate decision. And, I think that Euro's probably see a bit of a bid going into the 9:15 announcement, and it'll remain strong because they're probably going to do 50. If they do 25 instead of 50, you can press that sell button and, get into that trade, because their guidance is not going to be hawkish. However, if they do 50, I still think it's probably after the first, I would say, 5 to 10 minutes of price action, you wait. And we did this with NFPs. You wait for the candles to close. You wait for the market to figure out what it wants. Then I think it's probably a sell, because I think everyone's going to be positioning themselves for also dovish guidance. So you can do all that, or you can wait till the ECB president speaks about 30 minutes later. After she speaks and she gets the first questions, I think, it's going to reveal they're concerned about inflation, but they're also concerned about the financial markets. That's when we get the true move of the day. So it's a very exciting event to trade. We love trading ECB NFPs.
Okay. Well, that's what I was going to ask you. Is I was reading the article a little bit this morning, which it said that because the SVB, it kind of would make it a little bit trickier for them, based off of where they were going to go and that sort of thing. Any take on that?
100%. And that's the game plan that, I've laid out to everyone, which is that, whatever comes, whatever move they make, the guidance is probably going to be dovish. And we'll talk again on Friday and see if we're right or not. And we'll dissect what happened. But I think that, they've been so clear in what they want to do. It'd be hard to walk back from that right now. And what's really important is what happens next. If they only did 25, they can't just do 50 next month. And so if they need to get it done, they need to get it done this month, and then indicate that they're slowing down, because they can still guide the market lower. So the game plan, is, you have some opportunity immediately after the rate decision. Then you have opportunity and probably more continuation after she speaks. Like the first 15 minutes, anything that is important that needs to be said is going to be said. Then whatever move that transpires is probably going to be the real move of the day. And I think it's going to be euro weakness. It may not be purely through euro dollar, because we have to see what's going on with the US dollar, but the crosses could be really nice opportunities.
Okay, excellent.
Yep, exactly. What she said.
Exactly. Boris, anything else you'd like to add? I'm looking here at the chat, just seeing if we have anybody coming through, but doesn't look like we have too many questions here. I think everybody's a little bit concerned at what's been going on, so they're kind of just waiting, just like we are, trying to react.
Right. Watch the price action. The price action will tell you the direction. Don't try to guess. Don't try to force it. And tomorrow's a big day too. So we'll come back and we'll see how it's trading. But wish everybody the best of luck. And like Kathy said, widen the stops, half the position is probably the best thing to do.
And take your profits when you have them, because things can reverse quickly.
100%. That's why I was like a little bit off camera, because I was taking profits, because you snooze, you lose. This, it's definitely the story here.
Yeah, you snooze, you lose. What was it? Assess, don't guess. Those are the two takeaways today.
Okay. Yeah. This week and onward.
Exactly. Assess, don't guess.
Well, guys, thank you so much for your time. I appreciate it. You guys have obviously given us some great, knowledge for this week to kind of chew on. Like you said, we need to just look at what we have in front of us, react to what the market's given us, and that's all we can do. But thank you so much for your time. We will see you back Friday. Of course, that'll be our therapy session to see what really happens.
Exactly. We're looking forward to it.